Hello, Brokers Are Better Facebook group. We are live. Please join the conversation. I'll give everybody a minute to hop on here, but we are getting ready to go live with Kevin Peranio from PRMG. So I'll give everybody just a minute to hop on.
Kevin, we got good signal here.
You got a good signal. How is? Obviously today was. From what I understand, talking to different people in capital markets, today was a very, very volatile day. Tell us a little bit about what you're hearing on your side.
Yeah, definitely. In fact, I'll even do a live look at MBS. I think it was volatile, but it was clearly a positive sign. Last Sunday, the Fed said we're going to put $700 billion to work, $200 billion into MBS. And it wasn't enough. Everyone looked at their rate sheets and wondered what the hell was going on. And this morning, the Fed said, okay, just kidding, unlimited purchases of MBS, and we're going to put $75 billion to work like today. And so what you're seeing on the Fannie coupons and conventional loans, you're seeing a lot of liquidity there. And that will reflect on the rate sheets. A lot of lenders, us included, improved our rates from last week. We took in a massive lock day. Everyone's been sitting on their pipelines waiting to see what's going on. There's still a lot of disruption out there, especially on the Ginnie side. And, as we get a broader audience, we can get into that because that's a very unique set of circumstances that is different than what just the Fed pumping in liquidity.
So let's talk about that because I did talk to somebody in capital markets earlier today that we had a little bit of a conversation about. I think Lakeview and Pangora hopped out. That basically said they won't be purchasing any securities, and they also said that they were some prior commitments that they had made that they're not going to be fulfilling. How does that impact mortgage bankers when these, the MSR buyers start to decommit to commitments they previously made, but completely give a forecast that they're not going to buy any more securities?
Well, there's always a market, right? So you've got multiple buyers and sellers of MBS on any given day. What was interesting last week, and let's just take the extreme version. Let's talk about Ginnie Mae securities, right? I don't think most people know that if you service a Ginnie Mae loan, FHA, VA, USDA loan, this is just talk about FHA since that's the bigger bulk. If the borrower doesn't make their payment, the servicer makes the payment. So we service loans. We have about 6,500 units in our portfolio. It's not a huge portfolio. We're not big guys. We have our own private money. We're not backed by hedge funds, REITs, or equity firms. They're the ones that are buying the money in bulk. Therefore, they have portfolios in bulk in massive amounts.
So explain that to the broker community. Like Lakeview says, we're out, and there's only, my understanding is only a couple buyers that are specifically in Ginnie that are buying in bulk. So if hypothetically they stop buying or the number of buyers are limited, how does that impact, obviously you and your other wholesale lenders that, sell servicing?
Yeah, I mean, we can either choose to retain servicing, right? So if there's less of a market, when you service a loan as a lender, which we do, about 10% of what we bring in. When you service a loan, you're taking cash out and you're fronting that money to pay the originator. Go, here you go. We're going to make that money on the come over how many years, right? And so you have a lot of things all coming together right now. So are these loans going to pay off early because there's a lower rate? So that's why you're seeing some lenders don't even put a rate out there over 3.75% interest rate because they could turn around and get refinanced tomorrow. So why would someone want to front the money and then service it and it's gone? So that's one thing. Are people going to lose their jobs? Or when they lose their jobs, what's my exposure as a servicer? And is that the best use of my cash right now when I could do other things? Even the big guys, the ones you've mentioned, I'm not going to mention any names, but look, I mean, everyone runs out of money.
Yeah, the world's ran by cash. So, at the end of the day, money matters.
I mean, all this talk about making Fannie, Freddie private and Ginnie private, who are you going to give it to? All these same guys that are now backing off? I mean, I've always thought it was a stupid idea, and now is a perfect example. This is going to be our last pandemic. We've had a pandemic, we had one in 2009. We had, it's going to happen over and over and over again. And so you need the explicit guarantee of the government to step in and say, hey, here's all the money you need to make this thing liquid, because all these guys who used to buy everything, they're just going to sit on the sidelines. I mean, look what happened in non-QM. Completely decimated. Nope, no one's buying any. No one's securitizing. No one's buying paper. Everyone. I mean, we had people talking to us last week. We'll front the money for a little bit. We'll float it. Now they're even saying, literally in days, they're saying, we're out. So I know there's still a couple left, but
I don't think it is. I think that's actually a good topic to kick this off, because I think it's important that people really, really listen to the. I hate to say this, but the messages I'm putting out there to my audience, to brokers, is to help them understand that I'm trying to avoid consumers getting into a situation where they think they're going to buy a house and then the money doesn't come, which we're actually literally seeing as we speak. And so last week, I sent a message out to the entire broker community after I talked to Gary Malice, and I talked to a lot of capital markets people that I respect, Jason Lee at Flagstar, people that know this industry. And the indication that I got from everybody was, hey, Anthony, non-QM, whether it's Friday, Monday, next Friday, the market is gone. It's whether somebody says they're doing it or not. It's completely going away for the short term until this whole situation figures itself out. So I went back to brokers and I said, hey guys, this is what I'm hearing. My recommendation to you is close what you can, but the minute you start hearing people say they're delaying, any new loan originations, they're delaying closings, this is a sign of everybody's going to be in the same boat, because there's just no money funding these securities. So for you, as somebody that did non-QM, a very small piece of what you actually did, really just kind of a complementary product line, how did that unfold, and how quickly did that go from 0 to 60?
Wow, so quick. So thank you for bringing it up and giving us an opportunity, and thank you for highlighting my partner here in the company, Gary Malice, who's our Chief Strategy and Capital Markets Officer. If anyone ever sold to First Magnus, he was one of the owners there, and super brilliant guy. Glad he's on our team for sure. So look. Give an example. Last year, as a company, we did about $8.3 billion in loans. About 240 million of it was non-QM. And we have a different mission at PRMG. We try and do everything for everyone. And we don't really focus on certain products and certain mixes and tolerances. We just try and help everyone in every way we can. And so you're right. It was a complementary product line. Now, we had a couple investors last week when you have to understand non-QM, there's no, when loan, all we do is buy and sell money. All right. So let's just talk secondary market. Let's get away from, the part that you and I love, the fact that we're helping people and helping the American dream and putting someone in a house and changing their life forever. Let's talk about the secondary market. We buy and sell money. And the secondary market is cold, heartless, and unforgiving. It doesn't give a shit about anything. Okay. And so what happened last week, non-QM is the extreme. Private money paper. We all know the names out there. Angel Oak, Citadel, Carrington, goes on and on. SG Capital, Galton, on and on and on. So what they do, Veris, they all pull their money together. They put them in packages and they hold them. And when you see articles talking about non-agency loans, you're typically seeing them talk about non-QM loans. So then they hold this money with their cash. They hold it. They buy from lenders. They buy from brokers. They buy from us, and they hold it in hopes that they will then turn around, package it, and sell a securitization on the market. Maybe 400 million, 600 million, 800 million blocks at a time. Last year, about 25 to 35 billion. I don't know the final number. 35 billion was done all in on non-QM. There could be that in a $2.3 trillion year. And so this year the estimates were 40 billion or more in non-QM. So the securitization market, the biggest buyer was PEMCO. They're the biggest buyer out there, and them and other buyers out there, they just said, hey, you know what? We don't know how deep this COVID-19 thing is going to go. We're not really happy with the stimulus package isn't passed yet. Phase 3, the Fed didn't do enough. This might not be the best use of our cash. So we're not going to buy any more securitization, and that's what we want to do, period, end of story. So now all the people who are middlemen, right, which if you're not a securitizer directly, you're saying, hey, you know what? I don't even have an outlet now. And even direct securitizers. You see Caliber when they put out their Colt securitizations. You see Angel Oak, they put out, Veris puts out, even direct securitizers. There's no market to sell to. So some of them said immediately, like, okay, this is like 2008, we're out. Let's just protect our capital, we're out. And the ones that said they're out to us specifically said, you know what, Gary, KP, Paul, Robert, if you have a loan that's locked, we will honor that lock and we will buy that loan from you. And they've told us that, okay? We have $5 million in loans already funded that are not yet sold. So, you know, we're sitting there doing the math like, okay, we're going to have to take $1 million hit if we have a 20% scratch and dent. I mean, that sucks if that's the case. But, you know, you take your licks and you move on. Not every lender can do that. There are smaller lenders who do that. There are smaller warehouse lines, small warehouse lenders that they can't afford to have a small lender have a non-QM on their line that's unsellable because neither one of the balance sheets at the warehouse lender that's small or the lender that's small can take that hit because cash is king. Is that the so anyway, so the market pretty much melted down. It changed again today, where some of the people last week who were saying, okay, you know what, we're still going to buy, nothing's really changed for us, or we're only going to buy max 80 LTV or minimum 680 FICO, and you know we'll still take on your business, bring it on, right? Now those people literally from Friday to today are like, well, you know, I think we're just going to kill everything. I mean, uncertainty is a real thing. It's what everyone looks for is certainty. And in the non-QM market, it's very uncertain and it's very fluid. You think we want to tell our originators to have a loan literally closing tomorrow? Sorry, you're not closing tomorrow. That's the worst phone call to make. It's awful. Because then you got to turn around and tell your realtor or your borrower or your referral source, like you got to tell them, and we're the one that put you in that position, but someone behind us put us in that position, and someone behind them put them in that position. And some asshole in China who made bat soup put us all in this position. So, you know, it's like, it's just a tough situation to be in.
So, all right. So on that point, I would just say the other part of this is the fact that I sent a message out to brokers and mini cores last week. And I kind of, my recommendation was risk, you know, this is a market that's going to expose a lot of people that were pretenders. And in my opinion, you know, I had a conversation actually with somebody you and I both know that's not a pretender. He's a billionaire and he's in our space. And he told me a year ago when I sat in his office that this was all going to happen. He told me that we were going to go into a recession, rates were going to plummet, liquidity was going to be optimal, and basically people that didn't have cash were going to be really struggling and the hole would be deep. And when he said it to me, I was like, yeah, whatever. But it's literally happened verbatim for what he told me. So as this situation started to unravel, when I talk to brokers or mini core guys, I try to focus on, hey guys, like now's not the time to be a gunslinger. Now's not the time to take risks because, you know, you know what you're used to is like, hey, I put a loan on my warehouse line, that guy's going to buy it. Well, what happens if that guy's not there and he can't buy it? What if he goes out?
What happens if the warehouse lender isn't there?
Right. Exactly. I mean, and we're already seeing that. We're seeing warehouse, you know, musical chairs already begin here. And I think for me, it's kind of minimizing what your exposure is and kind of one of the benefits of being a broker. And I'm sure, you know, a lot of bankers don't like it when I say this, but like, you know, being a broker, you can minimize your risk. You get to be an originator. And yes, you know, that does mean there's certain things if you have a warehouse line that you lose out on, but like, guys, honestly, this is not the time to be, you know, a gunslinger. Like when I look at VOEs, I had a guy come and cut my hair a couple of hours ago. That's why I look all tightened up. But so the guy was here. He was telling me, he's like, our whole entire barbershop, all, you know, 20 people that cut hair, all out of point. They're all unemployed now. So I'm sitting there thinking while he's cutting my hair, I'm like, those are people that they don't have a paycheck this week. The restaurants they eat at, they're all closed. Think about all the economics that change now.
Yeah, and their income loan and non-QM just got wiped out too.
But think about making your mortgage payment. Like those people, like they're you know, this is a guy who makes $80,000 a year cutting hair. He's going to $500 a week on unemployment. You think he can make his house payment or his car payment? No way.
So you actually bring up a very, very good point. And I saw a really healthy discussion. Mike Cortis on his page, he's one of the founders of Nexa. I saw a really good discussion about this. So exactly what you just said. So remember, so let's go back to that securitization thing, right? We buy and sell money. The people who already own mortgage-backed securities right now, they're sitting there going, okay, people aren't making their payments because they're losing their jobs.
Yep.
It's an unfortunate situation. So I have mortgage-backed securities, especially with Ginnie Mae. Like the servicers right now, if every FHA borrower in our portfolio, if they don't make their payment, we have to make the payment for them. We front money for the TNI. That's extremely expensive, right? So when you see the policies that are coming out there, there's a lot of lobbying efforts. The Mortgage Banker Association is stepping in and trying to push. Obviously, the GSEs are trying to make sure that their issuers and seller servicers are taken care of. The reason that existing borrowers are being taken care of first. Who wants to buy a new mortgage-backed security on a new loan if the old ones aren't performing? Yeah. And there's no stopgap measure like, hey, you know what? We're going to give you 60 days forbearance, or we're going to give you 6 months, or we're going to give you 12 months. So they're to take care of the existing bond holders and servicers. They need these forbearance policies. Someone made a comment online like, oh, well, here we are again, if borrowers don't have to make their payments, then that just screws everybody in the industry. It actually helps us. It's the exact opposite. So last week, when these large aggregators who buy humongous tranches of MBS, the ones that you said are not buying anything, they're waiting to make sure that the Ginnie bonds are shored up. So the fact that a existing FHA borrower is being given a forbearance because they clearly lost their job. Okay, they can document, hey, I lost my job, the hairstylist you brought up, or the restaurant or the bar, I'm unable to make my payments because of this shelter-in-place policy. Then it's kind of like a pause. And then that, they just add those payments on the end. That's what a forbearance is. If it's a 12-month forbearance, then, you're in essence in the loan for 31 years. But 12 months there in the middle, you didn't have to make a payment. So helping these borrowers get relief for their payment saves capital and cash for the existing bondholders. I was on an MBA call this morning. They said between $15 and $25 billion is being outlaid by all the bondholders for payments on Ginnie Mae bonds without this relief.
So basically, what happens is it's a zero-sum game. So like if they're sitting there outlaying payments for existing borrowers that aren't making their payments, and we want them to keep liquidity in the market for new borrowers, essentially the money runs out. If it's going towards all the old borrowers, then it can't go towards the new borrowers. So hopefully this, what they're talking about from a bailout or a forbearance process, if it gives them relief, it keeps liquidity in the market for new Ginnie loans, is what you're saying.
100%. And that's not the only issue facing Ginnie bonds. So then you have, okay, now we're taking on new loans, and we've closed. There's probably some emerging bankers on this call who have a warehouse line. They kind of do like conventional, they do warehouse line, and then they do, they broker their govy. This is the greatest lesson that they get to learn right now. Their lines are taking longer to have loans purchased generally, right? And if they ever wanted to get into the Ginnie game and get their full legal, they would have to make sure they have cash to make these payments on behalf of their borrowers, unless, of course, there's a forbearance or some kind of relief. And so cash is king, and having that cash, or in this case, no one has enough cash, and the ones that do, they don't want to spend it on other things when there's still uncertainty. So creating certainty for forbearance policies and payment relief helps shore up the program. Then that's not the only thing. So now you got new loans that are being done. So let's say that a non-Dell client closes and funds a loan, they turn around, they sell it to one of the lenders. And in the time it takes between them selling it and it being purchased, the borrower loses their job. That small non-Dell correspondent, they're out. No one's going to buy that loan. The borrower doesn't work. So there's no relief there. So that's something people have to worry about. So when you say gunslinger, man, so, you have to look at these things like, okay, you've got, is this person truly working? I love some of the VOE relief that came out this morning. Like, okay, maybe the employer is closed and they're not able to answer the phone, or the work number isn't available. You can give a snapshot of someone's bank statement and show the payroll came in that day or the day before. Those
are like alternatives if the person still has a job. But when you fund a loan and it's on, and hypothetically you're a banker and it's on your warehouse line, and then you go to re-verify that employment before you buy that loan and they lost their job, you're screwed. I mean, like plain and simple, we're not talking alternative verifications of employment. Last week, 2.8 million people lost their jobs. The expectation is this week could be double. We're talking about million. Like when you go back to the monthly unemployment or the monthly job gain loss report that comes out, a great month would be 300,000 people got a job. 2.8 million people lost their job in 1 week. That was in a whole month. So if you're talking about 4 to 5 million people lose their job this week, I mean, this is uncharted territory at a level that we've never seen before. That's why, I'm trying to help everybody balance like that. At the end of the day, the most important thing for everybody, originators, appraisers, title companies, is that we're all in business at the end of the day. The guys that are lending money go out of business, meaning they get stuck with a whole bunch of loans where VOEs come back and the people are unemployed. It's great if you're an originator or a broker and you got paid on the deal. But if that becomes a huge issue for a lender and that puts them out of business, that's not good for anybody. And that's not what we want at all. We at this point back that they're not employed, that's $100,000 hit right off the bat that you take for a scratch and debt.
Yeah, again, I mean, let me take my friendly, fun-loving KP hat off and put my secondary hat on. The secondary market is cold, heartless, and unforgiving. They don't care that this person lost their job. They don't want that loan. And the reality is, with $5 to $6 trillion in loans eligible for refinance, we really should be kind of pivoting more towards the people with jobs anyway, to make sure that the system can handle the loans that are good. In 2 or 3 months, these people will be back to work. The underwriters will look back and go, yeah, there was a gap in employment, but they're back to work now. And the reason why there was a gap is because of the shutdowns, the shelter in place, or whatever. They're back to their job. They have 30 days worth of pay stubs. We're good. They're a teacher. It's that's not a big issue. It's not like they lost their teaching job. People got to go back to school. All of our kids are at home. We got 4 rugrats running around my house right now. I know it's a nightmare at most homes out there. So again, I mean, if there's no job, there's no income. And I want to say there's another thing that's attacking the mortgage-backed security market, and that's prepay speeds. You've got liquidity. Okay, you've got forbearance relief to make sure that loans perform that are existing. You have new loans coming in to make sure that people have a job and will pay, and they're good quality. But then you don't want to do a loan at 3.75% because it'll be refinanced the next day. So everyone looked on the rate sheet last week. I saw some lenders with zeros across the board, 3.75 interest. Like we don't want this loan because of course the next day they're eligible for refinance. So you have a confluence of many factors all kind of heading in at once. I will just say this. This is only day 6 since the Fed rate cut down to 0. I liked the move that was made this morning. We may just have to exercise a little patience and wait a week or two. I know a ton of loans got locked today. There's still a ton of loans being moved across the finish line. And there's still plenty of borrowers out there that have jobs. The ones that don't, that they may have to just wait till they get back to work. I mean, obviously, there's no non-QM market for them. Purchases, talk about purchases for a second. I'm seeing some borrowers are kind of fearful, like, is this the best use of every single penny I have left in my bank account to put down on a house when there's so much uncertainty? We're seeing some borrowers, I don't like to extrapolate. We're seeing some pull out. And so a lot of originators are taking the tactic where they're saying, hey, seller, why don't you kick in 2% and sweeten the pot so you don't lose your borrower, or else you're screwed too. And so we're seeing a lot of renegotiation there, which helps make up for the fact that there's less yield on the rate sheet to get us across the goal line. So, there's a lot of adaptation by the originators. I know a lot of originators are working for less. They're cramming down on their comp just to get things across the goal line. I mean, but again, this is day 6 since a Fed rate cut down to 0%. And what I will say is what's unprecedented is the health crisis, the pandemic, the fact that's what's unprecedented. What's not unprecedented is this kind of meltdown in the market. Actually, this isn't as bad, in my opinion, as 2008. We don't have a faulty financial system. Banks are liquid. Banks can borrow money. They're being picky and choosy what they spend their money on, but the Fed got out in front of this super quick. There's already 2 rounds of government stimulus that's come out. We had a second phase of Fed stimulus this morning when they said unlimited MBS, and then they backed up some other markets like the TALF market. And I think there will be a $2 trillion or more net effect stimulus bill coming from Congress once they kind of work it out between the two.
But the only problem, KP, the only problem with the move the Fed made today is, let's just think about this real quick. The Fed, I mean, at the end of the day, this is a confidence game. So, the Fed last week pulled out the zero rate. They cut the Fed rate down to zero. So there's nowhere else to go below, zero. So now that trick has been used. Today, last week, they came out and they said they were going to buy $200 billion in treasuries, in mortgage-backed securities.
Mm-hmm.
Then today they said it's unlimited. So that trick is gone because there's nothing greater than unlimited, right? You can only buy an unlimited amount, right? I mean, so we have two tricks that are done. If this continues to be a dire situation, investor confidence deteriorates, markets continue to be just mass chaos every single day. What else can the Fed do that, I mean, at this point, like it seems like all that they can do is kind of maxed out. Now it's just, can this, $2 trillion, multi-trillion-dollar federal bailout by the government get through, Congress and Senate? Is that pretty much the next line of defense?
Yeah, that's the next line of defense. And I think there's another one on another scale, which is a national quarantine, a national shelter in place. And that has huge economic ramifications in addition to the job losses that you mentioned that are coming and mounting and the impact on that. A $2 trillion stimulus package is the equivalent of, let's just say, 10% of our GDP. And we don't have Q1 rough estimates yet, but January and February, for all intents and purposes, were probably 2% GDP growth. But people think that March alone with this pandemic will bring Q1 into negative GDP territory. And so everyone feels for sure we're already in a recession, and Q2 would also be a negative GDP based on what's already happened. And it could get worse. So I would say that there are there's a little more ammunition out there. I mean, the next $2 trillion package doesn't have to be the last one. I mean, remember, the Fed and the US government can just print money endlessly and just do whatever it takes, have a do whatever it takes attitude. And if they do that, the risk is, okay, we might have inflation later, but at least we have more money to deal with. I mean, what's money worth if your grandmother is dying of, coronavirus?
Right.
So this is what we print this fake fiat currency for anyway, is to take care of our own. And so look, this $2 trillion package isn't the last. If we need more, they'll do more. I have confidence in that. So I think this is better than 2008. It's a worse type of natural disaster than, say, a hurricane, because it affects the entire globe, not just our nation. But again, we were due for a recession anyway, and this really just kind of put us through it. And like you said, the people that you were talking to that has been seeing this coming, we've all been seeing a recession coming. We just didn't know when.
Yeah, I think, but I also think that this recession could be bigger and long. I mean, like, the implications right now are pretty substantial. I guess the question I have for you is, when you think about things like, obviously we have unemployment and everything that's going to be growing as this continues. The more shelter in place happens, but in 2008, when the financial crisis happened, the people that were getting bailed out at that time, we were talking about Wells, we were talking about Countrywide, which was Bank of America, Morgan Stanley, Goldman Sachs, like huge entities, Fannie Mae, Freddie Mac, AIG. And at the end of the bailouts, when when everything kind of recovered, they all had to pay back the money. And the question really becomes this: is like, U.S. taxpayers actually made out very well in all those deals. Like, we, at the end of the day, AIG, Fannie, Freddie, like, massive profits. They actually got more back than they lent out. I don't know if that happens this time, because right now we're talking about who's getting bailed out. I mean, the American consumer is just getting bailed out, and there's not going to be a repayment plan on this money. So what issues potentially come on the other side of this if, we've massively increased the size of our country's debt? What are those impacts?
So consumer spending is anywhere from 65 to 75% of the GDP. And the consumers aren't working, and some are dying. So the focus has been mostly on them. I don't see a bailout situation here. There's been a lot of talk before this happened. Should Fannie and Freddie and Fannie and Freddie be privatized? Should we recap and release? I mean, can we please kill that conversation now? Like that should never happen. Just make it institutional. It'll always be backstopped by the government. Literally never talk about that ever again, in my opinion. I mean, I don't know if they would even be able to move fast enough to handle what we're doing. Plus, a central bank wouldn't be a central bank if they let others in on the game, right? It's one person to make the decision. Hey, here's the money. I'm going to print it. We're going to roll. Not consulting anyone else. Here's the plan. And so there's something to be said about that efficiency. So let me say this. I don't know that we're talking about bailouts. I think we have. It may not feel like it to us, but to me, having lived, been in the business since 2001, which doesn't seem like that long, but I guess now it does with this 2008 crash, being the precursor. I think what a free market usually has is, big fish eat little fish. So if someone doesn't have the capital and they can't make it, well, their business just doesn't make it. And so the government has to decide, is it an essential business? Like, so for example, the airlines, right?
Yep.
So the airlines, obviously, transportation is a pretty major part of our economy and our threat. So look, as much as I hate the customer service on American Airlines, and I'm from Dallas where they're based, I wouldn't care if they went to shit. But to be honest with you, it would be bad for our economy if they went out, right? And so if the government steps in to bail out anything, it's probably going to be industries like that they deem essential, and they're going to put their hooks in there and make money on the rise, on the come, just like they did with Fannie or Freddie. I think something like $180 billion went to the Treasury, raked from Fannie and Freddie before they finally, just a couple quarters ago, let them start keeping their own money. So I think the taxpayer will get paid back because the government wants to be the person saying, hey, here's the money. I'm printing it for you. I'm going to save you, American Airlines. You've been mean to all your clients, but we still need you. But we're going to take 20% of your company, or 51% of your company, or 40% of your company, whatever the case may be. Frackers, we need you because we need energy independence. So we're going to bail you out too, because Putin and the Saudis decide to come after us and hit us while we're on a downturn. So, so much for them being friends or allies of us. So we're going to bail out the frackers, but we may take a little piece of them. So I think the taxpayers long term are going to come out of this. The government's going to put their hooks in the businesses they deem essential. Back to us in the financial markets. I mean, we're not in a today.
Yeah. I mean, don't speak
today. Yeah. Today, we're not in a bailout situation, right? And so I think a lot of the moves are being made to try and avoid having to bail out and shore that up. You're seeing a lot of this liquidity move quicker and sooner. I mean, 2 historic Fed rate cuts before the meeting, down to 0 on a Sunday. And then a week later, unlimited MBS purchasing and Treasury purchasing. I mean, those moves are unprecedented to make sure we don't have something worse than what we experienced in 2008, which we were out of within a year and a half, which, by the way, after the market rebounded 40% from that crash, we got hit with the swine flu. I think something like 60,000 people died in America, some crazy number. So this isn't our first time coming out of a financial crisis and dealing with a pandemic. It's just our first way of dealing with the pandemic in this way. But I mean, it's a great question. I don't have a crystal ball. I don't know who's going to get bailed out, if someone even needs to. So
let's go back to the one of the things that we've been talking about, because it is a big issue that and more brokers, because we're having these conversations, are being made aware of the impact of things like margin calls on businesses. And I mean, I had calls today. I had some calls earlier today in the first half of the day where people in capital markets at different lenders were not exactly, things were getting really chippy out there. So, we've had this conversation about potentially, there's lenders that have discussed, requiring a loan to be in some type of disposition of proved or some type of underwriting status in order to justify, hey, this is a real loan. Matter of fact, Provident Funding, they for years have had a policy where, you can lock before you submit it. But if you're like a tier 2 broker, basically you have to submit the loan to underwriting before you can actually get an approval. And that these are all capital markets related reasons why they do these things. But in the last 30 days, because of the fact that so many people have locked a loan and moved it to another lender and moved their pipeline and left that lender with a margin call that basically they have to eat. And because the size of the movement is so big, I've had conversations with a lot of lenders that have said, if this volatility continues, the need of potentially having to require a loan to be submitted to underwriting to allow for a rate lock is going to happen. And it's not going to happen like a week from now or 2 weeks from now. It could happen tomorrow because of the level of impact that it is having on lenders. So, can you talk a little bit about, that financial risk and the burden that, you as a banker and other of your peers are dealing with?
Yeah, of course. So margin calls have always been in our business. They've always been our business. So I was at First Magnus for many years, and then I had my own lender in South Florida after the crash for 3 years. And I trained people to hedge, and I understand it. I mean, I know I had a margin call, and I've had it where the market goes sideways. So what you do is you have your pipeline, okay? You take in all these locks, and then you wait to fulfill them. And so one of the greatest, there's two huge advantages that a lender has, is if a loan doesn't get locked until it's ready to close, then your time of exposure of having that lock out on the market is as short as possible. Like people taking a 60-day lock or a 90-day lock. I mean, what happens if everybody locks all their loans at 3.5% today, and literally in 2 weeks or in 3 weeks, like, hey, we're doing 2.5% 30-year fixed.
Yeah, what do you do?
Yeah, I mean, so, and here's the thing. Originators, you try and fulfill and honor your commitment, but sometimes the borrowers are like, well, dude, I'm shopping online.
Yeah.
I see over here. I mean, if you don't give it to me, I'm leaving you. And so, the bar, you guys hear me talk about the fourth industrial revolution. We got this cell phone, and where Evan Wade is, iPhones are not near as good as the S10, buddy. But you're in the fourth industrial revolution. We've got what you want, when you want, how you want, interconnected globally, on demand in the palm of your hand. So borrowers are getting information. Well, that guy over there I see is advertising a 2.25% rate or a 2.5% rate. So prepay speed is a big deal. So if we're waiting to lock until we get as close to the end of the line as possible, especially if the market has the potential to have lower and lower rates as we go into this deeper in this recession,
it's probably not. It's probable at this point. I mean, you can almost bet on it that based upon. I mean, right now the market's trailing where rates should be. So it's not just probable; it's likely.
Yeah, gosh, I hate saying stuff like that because as soon as you say it, the market goes back the other way. But look, there is certainly a trend of lower rates. We saw it happen the last couple of days, but the last week isn't a good barometer. We have to kind of see this thing out and get a little bit of a trend. Go to my LinkedIn video. I did a video last Thursday night talking about like stability of rates, and then all of a sudden they drop down, and that's where the margin calls come in, which you talked about. So rates were pretty steady throughout January, and then they got a little bit better and stayed within a range throughout February. And then all of a sudden, the first week of March, they hit historic lows. So pretty much every loan, 3.75% note rate and up, I mean, could be potential for a prepay and potential for a refinance. So, when you're hedging your entire pipeline as a lender, you have these things, you call it a market shock. So a market shock is 50 basis points swing, 100 basis points, 150, 200. Last week, almost every single day, it was 200 basis points up and down all day. So where do you mark it, right? And from that first week of March, the low rate, and everyone came in, we had $1.2 billion in locks the first 5 days of March. We had $1.2 billion the whole month of February. And that was $700 million more than we had February last year, which we've been staffing up a ton. So look, what a margin call is basically, it's basically a revaluation of an asset. All right. So So Clayton Collins, CEO, Housing Wire, had a great podcast with the CEO of the MBA, Bob Brooksmith. And a margin call is basically like, okay, I've got all these loans locked in February, and they're all at 3.875. And now the rates out there in the market are 3.25 or 2.875. So all that hedge position, all those securities, which I haven't funded those loans yet, because it's still just the first week of March. I haven't funded those loans yet, but I'm working through it. They're out of the money. They're out of the money. They have higher prepaid speeds. People are losing jobs. People are sitting at home. People aren't working. The existing ones aren't performing. So warehouse lenders and broker dealers, they start saying, okay, what's going on? Where's your cash position? So I want to explain what a margin call is, because I had a really good text back and forth with Clayton last Thursday night. So a non-bank like us, we have to use a third party called a broker dealer, because they're licensed and they're able to buy and sell mortgage-backed security positions on the market. So if they buy a position on our behalf, they know that they fronted the money for us because they know we're going to make good. It's called a TBA, to be assigned. We'll throw some loans in there as we fund and stuff it, and move on.
It's not transaction specific. It's note specific, note rate specific, but it's not like, hey, Jim Smith at 143 Main Street. It's more of a block of money.
Yeah. So yes, TBAs are coupon specific with different characteristics in there. I mean, it could be second home, primary, LTV this, FICO that, but it's all in that note rate. And then there's something called bulk bidding, where it's many different note rates, but you get the loan level data. Say here's my tranche of loans, here's 1,000 loans, here's all the data on it, and it could be anything. I want to say just real quick, I'm glad you brought that up. Gary Malice, my partner, one of the owners here at PRMG, about 2 years ago, him and Rob Kessel, super brilliant guy, and some other people at Compass Analytics. He's an MIT grad. They got together, and some other people out there, they created a new securitization instrument that our entire industry has now adopted, where you take a TBA trade that's just a coupon, okay? And then you take the characteristics of individual loans, like in a bulk bid, and you put them together. So you get more color and more detail. And that helps the people who buy and sell that money at the end of the day get more visibility on what they're buying. That actually created better execution and visibility for our entire industry. And that's something that my partner here, he created. It was awesome. Him and some other people, not alone. So anyway, to your point, if that asset, okay, all those loans in February that are locked are now out of the market, and us as a non-bank or any other non-banks, okay, we know who the non-banks are, okay? They use a broker dealer to go buy and sell those money positions. So when those money positions are out of the market, a 200 basis point swing, and I remember talking to you at AIME, and you said, hey, I'm hearing a lot of talk about margin calls at AIME Activate. That seems like forever ago. It was only 2.5 weeks ago.
Feels like 5 years ago.
I know, right? I was like, well, yeah, we had our broker dealers asked us for $4 million. So we sent out $4 million, and it just sits out there until we end up stuffing the loans in our trades, selling them off, and then we get our money piece by piece. Or what happened last Wednesday and Thursday, all those trades came back in the money. So all those
the time being.
And they went back the other way today and Friday. So our broker dealers gave us our $4 million back on Thursday, and anyone else that had a margin call, they got their money back. But there was a little time there where they had a lot of money they had to put up. And so then warehouse lenders and other lenders start to look and go, okay, well, do they have the cash to put up these margin calls? So one of the things that Clayton and Bob talked about was like, this is just a revaluation of an asset. It's not an income event until the loan
close on the loan, or you don't close on the loan. Because then if you don't close on the loan, the bank, you guys take the loss because you never filled that TBA.
And then we pay it.
And then you pay that out. If you close on it, then you get all your money back for the time being, as long as there is an EPO.
So if we don't fill that trade at that old rate because of an originator flipped the loan on us, we pay what's called a pair-off fee. But if the market swings so much, the broker dealers come to non-banks and go, yeah, we're going to anticipate a lot of pair-off fees, so we're going to need a margin call just to make sure.
And you have 24 hours to pay. So margin call Monday, I talked to a lender this morning that told me, hey, listen, if this goes on today like this, and this isn't even like the number one wholesaler, this is just a top 5. And they said this could be $100 million margin call day based upon what's going on in the market. So today the market moves like this. By the way, there's no insurance fund. This is like, you got to stroke a check, and you got to wire the money by tomorrow. So tomorrow they call you, $100 million due. Either if you make the payment, great. If you don't, you're out of business.
Yep. Hey,
so
chalk it up
like you said, the secondary market is one cold,
heartless, and unforgiving.
Yes. So I guess the reason why I bring this up is right now I'm a lot of the communications that I'm trying to get people over is the emotional. How is this impacting me? And I hate to be this person because you even say it to me sometimes, like, you have to put yourself in somebody else's shoes, but like, I hate to be insensitive, but like, guys, like, people are talking about the price they're seeing on the rate sheet and why was it good between 3 and 4, but they shut it down. It's like the volatility when we're talking about hundreds of millions of dollars. This isn't JP Morgan. This isn't Wells Fargo. These are non-bank lenders. These are PRMG, UWM, Caliber Home Loans, companies that don't have $1 trillion or $100 billion balance sheets. These are companies that literally, when they're stroking a check for $100 million or $50 million or $10 million, it has a huge impact on their day-to-day operations. And I think right now, one of the things I've seen in the last 7 days or 8 days is it's compounding issues because you can't sell servicing because there's no value on anybody's existing servicing portfolios. You have this whole warehouse capacity issue. And then you have margin calls, which are a day-to-day, depending upon the market, could be good or could be bad based on your situation. And it seems sort of like the perfect storm for an independent mortgage banker.
Brother, like Chase and all the other banks, they don't have enough money to withstand this. The only entity that does is the Fed. And everything you just mentioned was so spot on. By the way, throw in a pandemic, throw in that people aren't working or making their payments. I mean, where does it end? And so, right, hopefully, it ends sooner rather than later. Again, there are other steps to be made. I mean, there could be a fourth stimulus once this third one gets passed. There could be other, like the repo markets being funded by the Fed. There are some other credit things that could be funded. I saw this morning, Citibank leads a commercial MBS that MGM is part of because the casinos. They're not making their payments. I mean, no one's going to Vegas, ghost town over there. So there's a lot of ramifications. It just shows you how fragile and how leveraged our economy is. I mean, people live paycheck to paycheck. Our mortgage-backed security market is based on liquidity on a day-to-day basis. Our treasuries, our national debt. I mean, we are over-leveraged. So a lot of what we're seeing is some deleveraging in the market. And I think it feels like, and what I keep reading and hearing about is that, a lot of the big money players are starting to feel like they've deleveraged out of whatever their risks are, whether it's equities or stocks. I mean, do you think a company like Apple should be trading at 250 right now? Hell no, or 175 or whatever, or 150 or whatever it's at. I mean, they have $60 billion in cash. But so people are trying to find the bottom, the people with money, and the Fed is trying to hold up the bottom, whatever that is that we have, and then you'll start to see stability in rate sheets. And I will say, it's only day 6 since the Fed made a rate cut down to 0. There are still measures to be taken place. I know the phones are ringing off the hooks because borrowers are saying, "Hey, where do I get that 0% 30-year fix? I saw the Fed rate down to 0, and I just did a loan last week. Can I refi?" The way to an originator's perspective, I would just say, keep talking to your borrowers and say, "Here's what I got. The market is changing every day, but what we can do is we can get out in front of it. We can get you started, get you in process, get you ready to go. And as soon as that moment's right, boom, we're ready to lock you and move you forward."
Yeah.
Because these lenders that are moving fast, they're a godsend for all originators.
Yeah, I think that's actually one of the things that I was planning on doing a Facebook Live about tomorrow was, somebody's going to call you and there's going to be a benefit for them to refinance right now. But if we know where rates are going, if we know what's ahead of us, and we say, which we don't, but to a degree, we really do. I mean, at the end of the day, like, even though we don't want to say, like, the Fed is, when they said we were going to buy unlimited mortgage-backed securities and we're buying all these treasuries, like, but the rates on our rate sheets are not translating. the market is protecting itself from EPOs to a degree. I mean, that is part of the equation right now. So like eventually this is going to sort itself out, and the rates that we see on a rate sheet are going to be, in the twos. I do think there's a common sense approach where we sit there and say, hey, listen, we have to protect ourselves as an originator. We have to say, like, if we originate this loan and 3 weeks from now or a month from now, somebody else could call them and refinance them, that's going to happen. So you have to be prepared for it. So it really is a matter of like getting it all ready, setting your borrower up for long-term success, and then seeing what happens in the market. Now, some people might say, well, what if my borrower loses their job? That is a part of this. That is also another part of the risk here is borrowers are losing their jobs. But what would you rather have? Originate a loan with an EPO 30, 60, 90 days after, which is a net for you, net gain, net loss. So that's nothing beneficial is there. Or would you rather sit there in a situation, most of your borrowers that retain their jobs are positioned to get the lowest rate when it does happen?
I think those are all good points, and just kind of put a ribbon on that. We're all in this together. And I would say that, all originators, no matter what you're doing right now, you're probably looking at the fact that your pipeline is enormous. You're probably going to have the best year you've ever had as far as fundings this year. But part of that means you will be paying EPOs, or you might pay an EPD. And so you're playing in that game alongside the lenders and everybody else. That if this market shifts, and we do have rates in the 2.5%, right? That is the going rate. You're going to have EPOs. So you should be saving your money as an originator as well, because you may triple or quadruple your business and make more money on the front end, but there's going to be an expense at the back for the loans paying off behind you. I mean, that's just chalk it up to the game. It's just, we're in that kind of market. This isn't the first time it's happened. This isn't the first time that literally every single loan in history is eligible for refinance. And when that happens, you need to save cash for EPOs. We don't want EPOs.
It's part of the game. And you're not in control. At the end of the day, it's like your customers are going to get trigger leads, mailers. They're going to get solicited by Quicken ads. I mean, they're going to get solicited, plain and simple. There's nothing you can do to shelter them from the mortgage marketing machine. So it's just part of the game. So I've had you here for over almost an hour, KP. Really, really high value content. I think the feedback has been overwhelmingly positive. Let's wrap up here. What's your message to the broker community in closure?
Well, again, I mean, we are definitely in unprecedented times as it relates to the pandemic. We are not in uncharted territory as it relates to the financial markets. This is something that we've been through. Our leadership team here has definitely been through. As it relates to EPOs, our take at PRMG has been the same. If we have one, the last thing we want to do is come to you and say, hey, give us a $10,000 check. We say, all right, you've been giving us X amount of business, maybe give us $1 million more a month for the next 3 months and we'll call it even. We don't want to burden you with a cash flow issue either. We've been hiring like crazy. And even at 8.3 billion as a lender last year, if we doubled to 16 billion, I mean, look at how much business is out there, right? So we're hiring like crazy, and we're trying to make sure that our turn times are better. I know, our disclosure turn time, I just talked to someone, we're teetering between 2 and 3 days, and but we're keeping our condition turn time at 1 day. And so that tries to take care of the purchase business to make sure we hit closing dates. So remember, we're decentralized fulfillment. So we have different fulfillment centers all over in your markets, and they will have different turn times. I got one center that's at 24 hours. I got one that's at 72. I got one that's at refi that's at 6 business days. So it just depends. But they all have a centralized disclosure team, which right now is taking 2 to 3 days. But we are rolling out a automated LE, and we rolled it out to some brokers, some of our select brokers, and we're trying to get that fast tracked here pretty soon. Look where we are on the rate sheet. I mean, look, we want to win as much business as we can, but there are a lot of other great lenders, and everyone's dealing with capacity in different ways and some are pushing refis out a few weeks and pulling purchases forward. Some are also offering a purchase money special on the rate sheet, which we are as well. There's just a lot of different ways to attack this. Just know that you've got, a privately owned lender that's capitalized like a bank. We're in it with you, in it together, and we feel good about this year. And I know for a fact that we're all going to have our best year, even if we're sitting at home in our damn sweatpants because we can't leave the house.
Well, KP, we appreciate your time, and obviously you're putting up the good fight every single day. So thank you. We appreciate you, Broker Nation. If you have any questions, please feel free to share them, and I'll make sure we bring KP back next week.
Thank you for everything you do too. Thank you, Anthony.
Appreciate
Cheers.
you, KP.
Yeah.